Hello, welcome to Finance Concepts by your Finance-ista Cynthia Bush. In today's video, I'm going to be talking about evaluating projects using internal rate of return, also known as IRR. Let's get started. So first, what's an example of a project? Well, a project is anything where you or a company is going to have cash outflow to pay for the project, but then you're expecting future cash inflows as a result of the project. So when we evaluate projects, we're trying to evaluate the return in dollars and percent of the overall project, considering both cash outflows and cash inflows. So on my screen now is a picture of the new or I think it's called spicy grilled chicken sandwich by Chick-fil-A. This is an example of a project. They experienced cash outflows to develop the new chicken sandwich, including the cost of the ingredients, the actual testing to find the right combination and mix of ingredients, any new packaging associated with the sandwich, any marketing and development costs, etc. They're expecting future cash inflow from the sales of the sandwich, which would be the number of sandwiches sold times the cost per sandwich, less any expenses associated with the sandwich. So cost of ingredients and so forth to make each sandwich, utilities and whatnot. So that's a project for Chick-fil-A. Another example of a project is the new Mercedes-Benz electric vehicle. So this is another project. The company had cash outflow to develop the vehicle. So that's the architectural renderings, the engineering, the software, the cost of the components to create the car, etc. They are expecting future cash inflow, which would be the number of these cars sold times the price per car, minus the operating expenses annually associated with building and producing this vehicle. And then finally, another example of a project is the project of deciding whether or not to go to college. So the cost outflow would be the overall cost of the college experience. So not just tuition, but housing and meals and fees, and also things like books and laptops, etc. That's the cash outflow. The cash inflow is the expected higher future earnings received as a result of a college degree, less any associated costs, such as interest expense on student loans. So these are examples of projects. So we can use internal rate of return, or IRR, to evaluate, does it make financial sense to do projects like these? So when you're evaluating projects, you always want to look at the cash outflow. That's the total cost to initiate the project. The cash inflows, which are the expected free cash flows after subtracting annual operating expenses. And you also need to figure out the timing of those expected free cash flows. And then there is a risk component, always very important in finance. So remember, you'll see me abbreviate free cash flow as FCF. It's effectively cash inflows, which should be something like your revenues, minus your cash operating expenses. All right, so suppose you borrow $1,000 at a 4% annual interest rate. You turn around and immediately invest $1,000 in a 1-year bank certificate of deposit that offers a 10% annual interest rate. So at the end of the year, you would have earned $1,100 from the bank CD, right? That's $1,000 times the 10% would give you $100. So you would have in your account at the end of the year $1,100. Also at the end of the year, you would need to pay the $40 of interest because it's 4% times 1,000. So that's the expense to borrow the money. So the question is, what's your overall return on this project? Because this is like a project. Well, there's two different ways you can answer the question about your overall return. One way is in dollars. So you could look at how much you made on the investment, that was the 1,100. Subtract your $40 of interest expense, that was the cost for you to get the money that you invested, and you netted or earned at the end of the day $60. So that's the return on your investment in dollars, $60. The second way to answer this question is by percent. And you can say, well, the investment was paying 10%. I'll subtract my 4% of interest expense. And so therefore, during the year, my investment earned a total of 6%. So you can answer this question either in dollars or in percents. Both are correct. This is an analogy of how we think about net present value and IRR. Net present value, or NPV as we abbreviate it, is another way to evaluate projects. If you're not familiar with it, please see my video on NPV. So when you look at the NPV of a project, you're really expressing in dollars the return of that project. So it's option 1 when you use NPV. When you are looking at the return of a project in percent, that's the IRR. And so that's a way to think about how we can use either one of these to evaluate a project. One evaluates it in dollars, the other evaluates it in percents. All right, so now let's talk a little bit more about IRR. So IRR calculates the internal rate of return that makes the project's NPV 0. Another way of saying that is IRR finds the discount rate that would cause the project's expected future free cash flows on a present value basis to equal the present value of the project's initial cash outflows. The IRR equation, which I'm showing here now, is quite a handful, but good news for you, you don't have to find the IRR manually. And in fact, I would not recommend doing that. So the equation, though, I wanted you to see it, it's essentially finding the present value of each one of the future free cash flows using some discount rate in the denominator called the IRR. And then setting all of those present values, the sum of all of them, equal to the initial cash outflow. So let's hit the punchline. When you find the IRR, you will accept the project if the IRR is greater than the company's cost of capital. Cost of capital is what it costs the company to finance the project. And you reject the project if the IRR is less than the company's cost of capital. So let's go back to that bank CD. You earned a total of 6% after you subtracted your expenses on that investment versus the 4% cost. So the project has an IRR greater than the cost. Therefore, you accept this project. It makes sense. You'll make money from it. If you want to know how much money, that's the NPV, right? And we found out you'd make $60. All right, so now let's take a look at a project. This is Project Xavier. Notice that Project Xavier has an initial cash outflow of $50,000. So that's how much it costs to launch this project. That includes any associated taxes, delivery fees, and any other expenses. That's the all-in cost. And it's negative because it's a cash outflow. Project Xavier then is expected to have 5 years of cash inflows, and they're here on the screen. Project Xavier's WACC is 7.5%. WACC stands for weighted average cost of capital. It's another way of saying this is the cost for the company to finance this project, 7.5%. To find the NPV of the project, we are just going to use the equation where we find the present value of each one of those 5 cash flows and add them together, and then subtract the initial cash outflow of $50,000. So the NPV of this Project Xavier is negative $2,337. There's a shorter way to do it if you have a financial calculator. So this is the nomenclature you would use if you had a TI 83 or 84, for example. You get the same answer for NPV, negative 2,337. But now let's look at the IRR. So again, here's the manual equation for IRR. I do not suggest that you use this, but you would manually try to solve for X. Okay, and it's actually quite cumbersome, but it can be done. The faster way, though, is to use a financial spreadsheet like Excel or use a financial calculator like the TI 83 and 84, which I've shown here on the screen. And when you do that and you input the expected free cash flows as well as the initial negative 50,000 cash outflow, you get an IRR of 5.73% for Project Xavier. Okay, so for Project Xavier, notice that using the NPV to evaluate the project, the NPV is negative, and we reject any project that has an NPV of less than zero. So on that basis, we would reject the project. But when we look at the IRR in the project is 5.73%. Well, that is less than the cost to finance the project of 7.5%. And so therefore, we also reject the project. So notice NPV and IRR, well, they come at it kind of two different ways in terms of evaluating the project, both come to the same outcome, reject the project. The NPV tells you how much money you would lose if you did Project Xavier. The IRR tells you that the return you would get on this project of 5.73% will be less than what it cost you to finance the project. So it doesn't make any sense to do it. All right, so now same project, Project Xavier, but suppose for some reason your cost to finance the project, your WACC, falls to 6.5%. So it now costs you less to finance the project. You can recalculate the NPV, and you can also recalculate, well, actually, you don't need to recalculate the IRR, but now you compare the IRR to the new cost of capital of 6.5%. Notice that both NPV and IRR say still reject the project. The NPV is actually a slightly larger number than when the cost of the project, in terms of cost of capital, was 7.5%, but it's still negative. So you reject the project. And the IRR, we still have the same IRR for the project, but now we're comparing it to the new cost of capital of 6.5%, which is still greater than the return of the project of 5.73%. So you still reject the project. Okay, so this would not be a project you'd want to do. You would lose money even if your cost of capital or your WACC falls to 6.5%. Notice NPV increases if the WACC decreases and vice versa. So this is a chart showing you a graphical depiction of IRR. The vertical axis is the net present value of a project. The horizontal axis is the discount rate, also known as the cost to finance the project or the cost of capital. So that's your WACC. So notice when the IRR is at 13% for this project, NPV is zero, that is the return of this particular project. Okay. So there are some great advantages of IRR. Number one is it's very straightforward to interpret. If the IRR is less than the cost of capital, reject the project. Also, it incorporates time value of money. Very important in the world of finance because the IRR is looking at the present value of the expected future free cash flows. And it's then adding those up and comparing it to the initial cash outflow, which is also in present value terms. So it absolutely abides by the time value of money concept. Another great thing about IRR is it relies on estimates of net free cash flows, not accounting profits. So in the world of finance, we are focused on cash. Show me the money. So it's very important to realize that IRR uses cash flows, not accounting profits. Accounting profits would be the last line of the income statement. That would be net income. But net income includes non-cash items like depreciation. So that's why we do not want to use net income or accounting profits when we're evaluating projects. You want to use actual expected future free cash flows. Now, there are some disadvantages of IRR. Two big ones are it ignores economies of scale and it's difficult to use to evaluate mutually exclusive projects. Let me give you an example. Suppose a company can invest up to $1 million in a new project. So they're considering Project A, which costs $1,000 and provides an IRR of 50%, which is greater than their cost of capital. So it's a project they can do. And it has an NPV of $500. Or they can look at Project B, which costs $1 million and generates a lower IRR of 25%, but that is still greater than the cost to finance the project, so it's still a good project. And Project B has a net present value of $250,000. The decision rule for IRR says you should do Project A because Project A has a higher IRR, even though both IRRs generate a return that is higher, both projects generate a return that is greater than the cost of capital. But if I'm a company who has 1 million to invest in a new project, I might actually prefer to do Project B because it's one project, right? So if I did Project A and I want to spend 1 million, I've got to do a whole lot of Project A's to spend that million on new projects. It might be much easier for me to do just one project, Project B, still gives me a very good return, still generates positive NPV. So that's an example of how IRR ignores economies of scale, meaning the size of the projects. And you can see how, according to the IRR rules, you would do the smaller project first, but from a company's perspective, it actually might make sense to do the larger project. So that's what I mean when I say it can be difficult to use to evaluate mutually exclusive projects. All right, some other disadvantages of IRR is that when you think about these projects, they are providing free cash flow, hopefully, otherwise you shouldn't be doing them at all. The free cash flows are money that is coming into the company after expenses are paid, right? So that's why we call it free cash flow. Therefore, that money can be reinvested by the company into other projects, or it can be reinvested into maybe an investment vehicle. But the IRR calculation assumes whatever money is reinvested from that project into a vehicle, that vehicle is going to achieve the exact same IRR rate, which actually may not happen. Another huge disadvantage of IRR is that it can provide conflicting answers if the free cash flow of the project has both positive and negative cash flows. Let me show you an example. Let's look at Project Stark. This is a project where you have an initial cash outflow of $580,000. Maybe this is a landfill. So to create the landfill, you've got to buy the land, prepare the land, get some trucks, etc. So that's the initial cash outflow. The cash inflow each year is the amount that trash companies pay to dump trash at the landfill. And so you see how much money the company is expecting to get for the next 3 years of income. The last year, year 4, the company expects that the landfill will have to be closed because it's full. In many municipalities in the United States, landfills can't go on forever because they would tower too high in the sky, and municipalities believe they would be an eyesore. So at some point, they are required to be closed. And to close them, many companies are required to cap the landfill with clean dirt to try to reduce smell, make sure there's no leaching into groundwater. And then sometimes they even have to do things like put a park on top of it. So that's why there's this big cash outflow in the 4th year. Now, if the firm's cost of capital, otherwise known as WACC, is 6.5% for this project, therefore, when you calculate the NPV, it's actually negative. So don't do the project. If I calculate the IRR, there are 2 IRRs. One IRR is 9.89% and the other one is 32%. There are 2 IRRs because there are 2 negatives in this stream of cash flows. Notice the initial cash outflow is negative and the year 4 cash flow is negative. So if you have 2 negative outflows in a project, you will have 2 IRRs. If you have 8 negative outflows in a project, you'll have 8 IRRs. So you cannot use IRR to evaluate this project, right? Because there are multiple IRRs. So if you look at a project's free cash flows and you have multiple negative free cash flows in the project's life, do not use IRR to evaluate the project. Use NPV instead. Here's another example of another project, 2 negative outflows. So without doing anything, I already know there are going to be 2 IRRs associated with this project. When I calculate the NPV of this particular project, which has a cost of capital of 12.27%, I get a negative 627 NPV, so I should not do the project. I can't use IRR to evaluate this project because I would get more than one. If you use a financial calculator, you'll get the first IRR and you have to do a bunch of other things to get the second one, but don't even bother. Once you realize there's going to be multiple IRRs, do not use IRR to evaluate the project. Use NPV instead. So this is a graphical depiction of that. Net present value is on the vertical axis. The discount rate or cost of capital is on the horizontal axis. The blue line is the IRR. Notice that it hits the horizontal line twice. So this is a project that must have at least 2 negative free cash flows. So there are 2 IRRs. Therefore, we cannot use IRR to evaluate this project. All right, folks, that's all for today on IRR. Until next time, this is your Finance-ista Cynthia Bush signing off. And don't forget to subscribe to my YouTube channel. Take care.